Insurance is sold as peace of mind. You pay a small amount regularly so that if something bad happens, you won't face financial ruin. It sounds like a fair deal. You protect yourself from risk, and the insurance company takes that risk off your shoulders. But if you look closely, something doesn't quite add up. Most people pay insurance premiums for years, sometimes decades, and never receive a payout. Yet insurance companies remain some of the most profitable businesses in the world. So how do they make money when they rarely pay claims? The answer lies in understanding that insurance is not built around accidents or disasters. It is built around probability, psychology, and time. Insurance companies are not gambling on luck. They are running one of the most mathematically calculated businesses in existence. When you buy an insurance policy, you are not buying protection in the way most people imagine. You are entering into a contract based on risk assessment. Insurance companies employ teams of actuaries whose entire job is to calculate the likelihood of specific events occurring. They analyze massive amounts of data, including age, location, behavior, health records, driving history, and industry statistics. By the time a policy is offered to you, the company already has a strong idea of how likely it is that you will file a claim. The key insight is this: insurance companies price policies so that, across millions of customers, total premiums collected are far greater than total claims paid. Individual customers may experience losses, but the system as a whole is designed to win. The business is not about avoiding payouts entirely. It's about making sure payouts are predictable and smaller than incoming money. Most people overestimate the likelihood of rare, dramatic events and underestimate how carefully risk is distributed. Insurance companies exploit this gap between perception and reality. Customers buy insurance emotionally. Fear of loss, uncertainty, and worst-case scenarios drive decisions. Insurance companies sell certainty in an uncertain world, and people are willing to pay for that feeling, even if the probability of using the insurance is very low. Time is one of the insurance industry's greatest advantages. Premiums are paid up front and continuously, while claims are uncertain and often delayed. This creates a massive cash flow advantage. Insurance companies collect money today for risks that may or may not happen years into the future. During that time, the money doesn't sit idle. It is invested. Investment income is one of the largest sources of profit for insurance companies. Premiums collected from customers are invested in bonds, stocks, real estate, and other financial instruments. Because insurance companies deal with long-time horizons and predictable cash flows, they can invest conservatively and still generate substantial returns. In many cases, the money earned from investments alone can exceed the cost of claims. Claims then become an expense covered by investment profits, not just premiums. Another major reason insurance companies rarely pay claims is how policies are structured. Insurance contracts are complex by design. Coverage limits, exclusions, deductibles, waiting periods, and conditions all reduce the number and size of claims. Many customers do not fully understand the details of their policy. They assume they are covered for situations that are actually excluded. When a claim is denied or partially paid, it often feels unfair, but it is usually contractually justified. Deductibles play a crucial role here. A deductible ensures that small losses are paid by the customer, not the insurer. This reduces the number of minor claims and shifts risk back onto the policyholder. From the insurer's perspective, deductibles filter out unprofitable claims and encourage customers to only file when losses are significant. Insurance companies also rely heavily on claim management. Even when claims are valid, payouts are often delayed. Documentation requirements, investigations, and assessments slow the process. While this may feel frustrating to customers, it serves a financial purpose. Delayed payouts allow insurers to continue earning investment income on the money. Over millions of claims, even small delays translate into large financial benefits. Fraud prevention is another factor that reduces payouts. Insurance fraud is more common than many people realize, and insurers invest heavily in detecting it. While this protects the system from abuse, it also increases scrutiny on legitimate claims. The burden of proof often falls on the policyholder, and many claims are reduced or denied due to insufficient evidence. Psychology also works in the insurer's favor. Many people never file claims even when they technically could. Some fear premium increases. Others don't want the hassle. Some are unsure whether their situation qualifies. This hesitation reduces claim frequency. Insurance companies understand this behavior and price policies accordingly. Lapse and cancellation rates further boost profits. Many policies are canceled before any claim is ever made. People change jobs, move locations, forget policies, or decide they no longer need coverage. The premiums paid up to that point are pure profit. This is especially common in long-term policies like life insurance, where a significant percentage of policyholders stop paying before any payout becomes due. In life insurance specifically, the math becomes even more powerful. powerful. Term life policies are often purchased during periods of perceived responsibility, such as marriage or parenthood. Many of these policies expire without ever paying out because the policyholder outlives the term. The insurer collects premiums for decades and pays nothing in return. This is not accidental. It is built into the pricing. Health insurance operates on a similar logic. Most policyholders are healthy most of the time. Premiums from healthy customers subsidize the costs of the few who require expensive care. Insurance companies negotiate aggressively with hospitals, doctors, and pharmaceutical companies to reduce payout amounts. What looks like a high medical bill to the customer often results in a much lower actual payment by the insurer. Another critical element is scale. Insurance companies operate with massive customer bases. Risk that would be devastating at an individual level becomes manageable when spread across millions of policies. One house fire is tragic for a homeowner but statistically insignificant for an insurer. Scale turns uncertainty into predictability. Regulation also protects insurers in subtle ways. Capital requirements ensure insurers can pay claims, but they also limit competition. High regulatory barriers prevent small players from entering the market. This reduces price pressure and allows established insurers to maintain margins. Brand trust is a final piece of the puzzle. Insurance companies market themselves as protectors and partners. This trust encourages people to buy coverage even when it is unlikely to be used. Customers feel responsible and prudent for being insured. That emotional reward often matters more than actual payouts. None of this means insurance companies are scams. Insurance serves a real and important purpose. It prevents catastrophic financial loss and provides stability to individuals and economies. But it is essential to understand that insurance companies are not charities. They are businesses optimized for profit through probability, time, and behavior. Insurance companies do not make money by avoiding claims entirely. They make money by ensuring claims are rare, controlled, delayed, and smaller than total premiums plus investment income. The system is not designed around fairness in individual cases. It is designed around profitability across millions of cases. In the end, insurance is a trade. Customers trade small, predictable losses in the form of premiums for protection against rare, unpredictable disasters. Insurance companies trade the promise of protection for access to massive pools of money that can be invested and managed over time. That is how insurance companies make money when they rarely pay claims. Not through luck, but through math, psychology, and a system designed to win quietly, consistently, and at enormous scale.